Welcome to StockOdds Odds and End podcast. We're getting ready for the final week of the first month of 2024. Good evening, Rob. How's everything?
Well, yeah, not too bad. Final 3 days anyway, and then we got two days of the new month. So it's one of those split weeks, and always an interesting when you've got some important economic reports on the horizon, which we'll let you talk about a bit later. We have a fairly long one today, so we'll try to get through it here. So Friday's action, we had some economic reports at 8:30, of course, and we can see that it launched the market up, but it really had a battle, very choppy, and we kind of gave up the premium. Now, right up here, we did pop to a brand new all-time high again, but it couldn't hold, and then we closed a bit lower than that high, of course. It wasn't a massive range day, but it was certainly expanded to the upside slightly. But the nature of these economic reports really were more of a sort of a Goldilocks emphasis, which is the consumer spending is still very robust, and yet inflation is moving down as we've been wanting or expecting, or means the Fed's doing their job, etc. So those things seem to be a little bit at odds with each other. Of course, you still have stronger employment, but it did. There was some housing data and things like that kind of said that there's more activity that way now. But it seems like it could have been the kind of report that really continued to move the market, and yet somebody was selling into it. The VIX started to rise here as we came down. We had some high signal. We went through the previous close. Any type of previous close crossovers are really important to watch for, and it can happen subsequently during the day besides just the first one. Also look for tagging the previous close and bouncing or reflecting off of it. Where are we on the daily? You can see that since our last podcast, we did move higher. Monday was Friday was very strong. Friday was the one that kind of launched us up and kind of took out these other two highs here. And then we built on this week, Monday, Tuesday, Wednesday, Thursday, Friday. We did sort of build, not as aggressively, of course, as that Friday activity. That was tremendously high signal and a slope upward pretty much for the whole day. Whereas these were sort of back and forth with some battles. There was some reversals and stuff intraday, like Wednesday, for example, pulled all the way back from a high. So there was some selling pressure that was seen, willingness to sell those highs. And also there was a bit of change, as we'll see here, in the leading of the guard. Look at the Qs. Wednesday's reversal, Thursday and Friday, you can see that they rolled over. Still, of course, elevated, but pulling back on those 3 days. Whereas the Dow, we did really well. And so this is what we're seeing more of, this sort of broader market kind of spreading out, investors still wanting to deploy capital into the markets, but not necessarily chasing only the Mag 7. And, especially, Tesla has been really getting pounded. We'll take a closer look at that. And IWM is not participating at all. This whole week was sideways. Now, it did have a good launch there on Monday. So Friday it had a long, and then it had that follow through into Monday where the other markets weren't so strong. But then after that, it went kind of sideways. This is still this problem with, is there really going to be growth in these smaller caps? Are they really going to prosper in this climate after we've had such a rise in interest rates over the last couple of years here? Are they really going to be able to build and get the capital they need and grow and stuff? So small caps still having a big battle, and yet we're in the best 6 months of the year supposedly for small caps, which is November through till April. But they did have a move, and they just might be like, that's it, because the narrative did change here, which was, hey, wait a minute, maybe we got way too much ahead of ourselves in expectations of interest rates being cut, which small caps love that story. But maybe we got way too ahead of ourselves, and that's not reality. And so small caps are sitting here on the fence, not making new highs like the other markets. So here's the performances for Friday and for the week. Energy took top spot both for Friday and for the week. Actually had good days all the way through. And that's one of the themes that Dave and I were talking about last podcast, was that energy complex, specifically oil, was a contrarian discount. I mean, it was, if you look at it that way, it was one of the things that was highly discounted and nobody seemed to want it. It was like most days energy was down, and yet we came to a point where it was looking very attractive from a contrarian perspective, and it has performed as Dave and I planned, right, Dave? we spoke in a dream. Well, it's always fun when you're right, but the market's job is to prove most people wrong most of the time. So when Dave and I are ever right, we just chuckle and just it's all for fun. It's like, we don't know, right? We don't know, but it was a good call nonetheless. Technology had a bad day on Friday, but I mean, it did okay for the week. Communication services, the Meta, Google stuff doing okay for the week. Financials popped up a little bit. Basic materials kind of in the middle here. Consumer defensive, it was interesting. On Friday, we had consumer defensive and healthcare did the best there. And so that was leaned a little bit more to the defensive, but actually our risk on list did slightly better than our risk off list, even though the consumer defensive and healthcare were in second and third place. Utilities down in the dumps, real estate down in the dumps still. So if we do start getting some cuts, maybe we'll see real estate pop up. Okay. So here's the performance for the week, and XLE taking the top spot of the sector ETFs with 5.09%, so higher than what you saw here for the week, because this is a broader market and this is just the sector spiders. So XLE taking top spot. On the bottom of the pile, consumer discretionary down here. I wanted to point out that relative volumes tapered off on Friday. Even though it was a full week of trading and so on, just because of the choppy nature, people just said, I'm not interested in trading today, and it backed off. XLU was the only thing that was higher than 1. Be mindful too of the differences in ATRs on them. If you trade ETFs, they're not all the same. Some have much larger ATRs, just like similar to stocks, right? You can see the volatility here as well, weekly and monthly volatility on those ETFs. Here's the map of the market for Friday. We had lots of damage done in semiconductors. I mean, I don't feel bad for them in the sense that they've been so strong for so long. But Intel and Plaque, I think, were the ones that were hurting this semiconductor patch the most. So, and then of course, energy was green, and the consumer defensive was mostly green, and the rest of it was, a bit of a mixed lunch, which kind of means broad market exposure, fairly healthy to see that. But these have been the drivers, semiconductors and tech, and they're having a bad day on Friday there. For the week, though, Intel and Texan doing the worst for the week, and NVIDIA strong for the week still. Google, Meta, as we mentioned. Amazon did okay for the week. Tesla having a horrible week again. Gilead, Humana, and even in the aerospace, you got Northrop Grumman, Lockheed Martin doing poorly, along with Boeing, of course. And this is always interesting to me, is the differences that you see between like Raytheon and Lockheed, or General Dynamics and Northrop Grumman and stuff. It's just so interesting when you see that they just peel off and go opposite directions. Same what you have here, American Express and PayPal, and some of these are all mixed up. But people love the reports from American Express, and it had a good week as well, up 9.97%. Daily chart of Tesla. I wanted to show this because we showed it last time, Tesla, and we were right here on this green bar, and then this is the next 5 days. So I wanted to point out that stocks often anticipate maybe there could be leaked information, or it could be just good research, good intuition, who knows. But ahead of earnings, they often do move in the direction of whether the earnings will be good or bad. And it doesn't necessarily mean that it's going to stay that way, or that if you shorted it just because it was down on earnings day that you would be successful. There's lots that can happen. But I wanted to point out that this was happening prior to the earnings announcement, which of course it did gap down. And now we went and tagged the 180 level. So quite a fall from 300 down to 180 in this last 6 months, 7 months. So Tesla having competition issues, recall issues, lots of other things going on there. And it might not be the end of the story. It could be more to come, or it could reverse. And now you have a big gap that will be a key. So whatever range we develop, and you've got to mark the gap, the top of would be where we started the gap. You got to mark that. And if we start trading into the gap, there could be a gap fill. So keep that in mind. Just like you saw here, a gap, it went and it filled the gap. So like you saw here, went and eventually filled the gap. Gap here, eventually filled the gap. So a lot of gaps get filled, and we just formed a new one. Keep that in mind. Now, opposite story for NVIDIA, where it's not been gappy that much, and it certainly has been walking up the upper Bollinger Band significantly, been very strong. We see all the reports from how many companies are buying their specialized chips, including Meta, and so there's a lot of demand. And for whatever reason you love or hate NVIDIA, just be respectful of the dynamics that are going on. And you can't, you sort of can't fight the tape. You have to wait for, opportunity where it's obviously changed and sentiment is completely changed along with traction in that. You got to wait for that. And there's better battles. I mean, if you want to get involved in, a good short, there are better battles. The volatility on this stock actually isn't that much when you consider it being as expensive as it is. It's what is the historical volatility? I got to take a look here somewhere. Hold on a second. I'm going to find it out. Where are we here? NVIDIA. The volatility, the weekly is the same as the monthly. It's 2.86% weekly and 2.85% monthly. So the volatility on NVIDIA is not that high. So in the kind of market that we're in, when the VIX is low, and especially with volatility on an individual stock is low, you have to respect direction. You're not going to get the type of reversals that you're thinking. You just have to respect the direction. And there's lots of stocks that have, if you talk about fundamentals, there's lots of stocks that have worse fundamentals. And especially on this, if the fundamentals are going to change for the better because of all the purchasing of their chips pronounced by these bigger publicly traded companies, then why fight it? Okay, just a common sense. Dave, could you see other battles, easier battles than this one on the short side?
Would not want to short this thing.
No, I know, but it's everybody always talks about it. It's like, oh, NVIDIA, I'm going to short this thing. No, can't wait to short it. I'm going to short it. It's going to go down, right? And you know what? They constantly get run over. So
there's no have to. It doesn't have to do anything. It doesn't have to come down. It doesn't have to stop.
Can't you find something easier to battle than this monster? I mean, it's up, what, for the year so far? Let me pull it up in a screener and just see what it's up this year so far. Since we're on the topic, anywho.
23% year to date.
Yeah, 23% year to date on top of what, 228% over the last year, right?
Year, yeah.
Something like that. So yeah, there's better battles. Okay, moving on. Here's the chart of the US dollar. So we had talked a couple of weeks back about this channel and be respective of the breakout either way. We did break to the upside. That did disrupt basic materials and energy, especially the metals in basic materials quite a bit with this move. And then from there, we went sideways, but we've had some fairly large range trading days, and that's been quite disruptive, and especially when it goes both ways. You know, it rallies and then sells off, or it sells off and then rallies. It can be quite disturbing in terms of the direction on, you know, the sectors and the types of stocks that are impacted. So continue to watch that along with the 10-year. 10 years sideways now. Volatility's calmed down slightly, and we kind of coming to a divergence in some of these moving averages. So again, respect this, which way it breaks out to, and utilize it to your advantage. You'll probably find that you're going to come to a point where it's going to have a bigger one-day move again like this. And it could be Wednesday, you know, with what's going on with the FOMC announcement, even though they don't do anything. It might be something they say, or other commentators, if we have any other Fed speak this week. But we also have some other economic reports that Dave will talk about that's important. But just note that we've come to kind of a bit of a convergence in the MAs, and we're looking for it to break one way or the other, and I don't know which way it will break. Here, it's crude that we talked about earlier. You can see the move coming back up towards that 80 from in the 70s or below. And again, still, I would say, if it can stay above this 200-day moving average right here and start to build, and especially if you can get through the 80, we do have some blue sky above, and I wouldn't be surprised if it can, in the foreseeable future here, can make another attempt to get up to 90 or even above, okay? There's the,
A crude awakening.
Crude awakening. That's good. That's good. Well, here's the ETF itself, XLE, the energy ETF, and you can see that this week it had every day was green, and so when we 1, 2, 3, 4, 5. So we had our a meeting right here, Dave, before this started. So what did we have? Yeah. So it had just turned this one green bar, and we looked at that price discovery and rejection right there, and closed on a up note on that Friday, and then Monday, Tuesday, Wednesday, Thursday, Friday. So I like it. I mean, it's still from this, even you can see on the ETF there's some movement up towards 85, 86 still possible. So energy is one of those things that, unfortunately, it's fairly volatile, and it can be like what we've seen in the past: one day up, one day down. Look at over here, one day down, next day up, next day down, next day up. You know, it can be very, very volatile that way, and tough to figure out. But I just thought that there was an opportunity here from a contrarian perspective, something that is discounted, discarded, despised, and yet, you know, when you look at how the market's making new highs and everything's getting, you know, really pricey that way, maybe this is the area to play in. Maybe there's an opportunity, and that's how it played out this week. Seasonality for ETFs. January, last 3 days. So Monday, Tuesday, Wednesday are the last 3 trading days of January. This is the ETFs. Any themes that we can see here, Dave?
Some of the risk-on high beta stuff is supposed to do better, like RKK, and weakness in oil. You see the XOP kind of weak. So maybe after all the strength, the seasonality will kick in there and we get some weakness.
And that could be the pause that we see. Yeah, absolutely. Now, it might not happen day one. This is for the next 3 days. What we should do here, Dave, is let's try to pick up some themes, and we'll compare this with the last trading day and see if that's the same, you know, lay, or does it flip? Because that would mean that maybe Monday and Tuesday could be weaker after this run that we just had. And then all of a sudden on Wednesday again, it could kick back in, right? So let's watch for that. So those are the ETFs. Semiconductors did have a bad Friday. Is that going to follow through here? Could be.
Mm-hmm.
But I mean, before Friday, they've had a pretty good run.
Yeah. And weakness in healthcare and financials is the other theme there.
Okay, we got some silver and gold here potentially performing. Look at the utilities. I mean, if that actually happens after they've been so despised last week and the week before, if that happens, that'd be fantastic. So keep your eyes on utilities long, semiconductors potentially short. Potentially, okay? I mean, right here, positive values versus negative values, not so stark, like pretty close, but still that's an edge. There's the stocks. So think about the stocks within the groups. Well, Dave mentioned XLE and the oil. Well, there's Chevron on the same side, right? Any other oils there? PSX.
And financials, we see Schwab.
And on this side, yeah. So
I mean, ones, DocuSign, Exact Sciences. Now,
yeah,
that's the RK stuff.
Now you might not want to tackle, say, Myrna if healthcare was supposed to be weaker. Then this is a bit of a conflict. But I mean, it's again not the same category as sort of a Lilly, which has much greater diversification, or Merck. But anyway.
And Amazon, it has earnings this week, so you may not want to gamble with that one.
Okay. All right. Yeah, it's interesting. This again, still a positive skew overall. Let me go into the last trading day of January for ETF. So remember, this is included in the 3 days, but we're just looking now just at only the last day. Now, don't let it throw you off here too much. Do we have any? I mean, we've got some. Yeah, but we got some leverage stuff.
Oil and financials. And financials are the weakness, but everything else is pretty bullish.
True. But I mean, you got it. Like this is a double, right? So you've got some leveraged ETFs in here as well. So it kind of amplifies it a bit. But yeah, I mean, this is so the seasonality for the last 3 days is modestly bullish, and then you go into the very last day. So January would then be one of the trading months of the year that has the last day as stronger, where many of them actually have it as weaker. Like most of the last days of the month are not as strong. They're like, we only have maybe 3 or 4 of the 12 months that are bullish for the last day, and all the rest are bearish. So let's look at the stocks here. So again, leaning to bullish. And what are we seeing? We cycle back in here now on semiconductors, AMD specifically. Now Myrna's still on this side, so it was there in the 3 days. It's still here on the last day. Again, some of those ARC components. And on this side, Cliff, CVX is still there. Alcoa is still there. Yeah, so a little bit more on the defensive side. So it still seems to be up till Wednesday here. It's more risk on. And commodities more, well, like it's kind of split between obviously the metals and the oil, but they're not both on the same side. But now it's going to be interesting as we flip over to February, the first trading day. What do we see? bullish again. So we've got ARC. You were just mentioning ARC components, but here's the ARC right top of the tier, semiconductors. So semiconductors look like they start the week softer, and then Wednesday and now Thursday, they're getting stronger. Okay, so just keep that in mind. That could be the roller coaster a little bit, because we just had a weak semiconductor day on Friday after earnings. That may follow through Monday and even Tuesday, and then the settlement window would be closed, of course, and then we're into bullish seasonality for the last day of the month, Wednesday, and then the 1st of February. Okay.
So financials flipped too. They were kind of weak the whole last 3 days, and then on the first day they seem to be stronger. So
right, and we have utilities flipping a little bit, although it's only a 50% chance of going down, and not huge. But yeah, there was some flipping, but still seems overall the theme for the week is a little bit more risk on, which is wild to consider. Like, we've been poking at these new highs again, and and it is a Fed week though, right? So if they don't do anything, well, we'll let you talk about that a little bit more later. But yeah, this is interesting. Okay, let's go to now we're the first trading day of the month, and then we go boom to the first Friday. What happens on the first Friday here? What is going on?
De-risking before Valentine's? I don't know. I don't know why.
What is going on Friday? So this is completely changed. Everything's down. Regional banking is up. We've got yeah. I mean, SDS is the inverse, the two times the SPY inverse, right? So that's bullish. So that means, yes, definitely down. Then what we got here, stocks. So Myrna's actually got it in all week, although the odds dropped off tremendously for Friday, but it hung in there. Stock use. So some of these held on for the whole week.
Yeah.
Right. Interesting theme. That might be the safer place as some of these that hang on for the whole week. But then look at the change in bias, right? We've got 83%, bearish and only 17% bullish. So then some of these risk on stuff like the discretionary and stuff flips over here for Friday. So I think there is a bit of a change to note, even though we have some themes still persisting, that we've got definitely a risk of a real inversion. It would be interesting if we end up Thursday, we end up like at a high, and then we gap up on Friday, or even start flat and start going down. That could be really good. So keep that in mind. All right, economic calendar. So Dave, take it away here.
Yeah, there's a couple of themes for the week. It's going to be employment, how the economy is doing, and then we have an important Fed announcement on Wednesday. So Tuesday, there's job openings, Case-Shiller Home Price Index. Wednesday, we have ADP employment report. And then the big thing is Wednesday at 2 p.m. Eastern, the Fed interest rate decision. Right now, it's looking like 97% chance of nothing happening, no change.
The Fed on the Fed Watch tool, yeah.
That's using the CME Fed Watch tool, yeah.
Right.
So
okay.
Even though that last day is supposed to be pretty bullish, people may hold off until that announcement and then make their decision as to jump in. And then Thursday, there's some economic data, manufacturing data, U.S. productivity, and then the first Friday of every month is about employment. It's U.S. non-farm payrolls, unemployment rate, hourly wages, things like that. So really the key event's going to be Wednesday, the interest rate thing, but how the economy is holding up and employment, that's going to be the other theme for the week. And in terms of earnings, it's earnings for the mega caps. So Tuesday, we've got Alphabet, so Google and Microsoft on Tuesday. And then on Thursday, we have Amazon and Apple. So of that fantastic 7, 4 of these giants are going to be reporting this week. So that could also dictate if we're going to continue grinding up on the indexes, or if something major happens it's game over.
True. Well, yeah, I mean, all of this plays into like this stuff is after the Fed announcement, so it's going to be important to set the tone for next week too, potentially, not just for Friday. And then with those earnings that are upcoming, yeah, it's gonna be another interesting week. And we're also split between, the end of January and the beginning of February. So I think it's a jam-packed week. I mean, I've seen this kind of action in years previous where like things are moving around, which is what we want as traders. So anything else?
No, that's it. We had those big earnings, and that's it.
So a couple items, food for thought. So because we've had such a meltdown on Chinese and Hong Kong stocks since their most recent peak 3 years ago. There's some changes that are coming there for suspension of lending of restricted stocks, which takes effect today already, and then further limitations on securities lending will be introduced from 18th of March. I mean, they just don't like stocks getting sold. However they're sold. And then you have the Evergrande liquidation, and you have Lebanon escalation and the Red Sea escalation, and on and on and on. It's just we're in a year of potential unrest and trouble in many parts of the world, and it's probably going to get worse before it gets better. And of course, we always hope that things get better. But right now, that seems to be the trend. No different than what I showed you with Tesla stock. It's like, we're in that season that things are kind of trending and volatility remains relatively low. So money managers aren't taking a lot of offsets, to the portfolios they're managing. Because the prospects for the U.S. market still are fairly robust when you consider an election year, when you consider interest rate cuts potentially, when you consider the amount of debt that's being created, which does assist the GDP. But there's been a developing gap. And I charted this recently. I don't have it available at the moment, but I charted the escalation of debt relative to the growth of GDP, and that margin has been widening, which means there's a lot of wasted money somewhere in the system where that debt isn't translating into a full payoff on GDP, and there could be a lot of reasons for that. So we're in a season of lots of suddenlies and surprises. I think are coming, and you guys be ready, and I also recommend largely trading hedged if you can, because that certainly will insulate you as best as it can, depending on what you put how you put things together, right? But anyway, thanks for listening to our podcast here, and hope it's some help. And you guys have a good trading week. Over and out.
Good luck.